Investing and financial advice have changed so much over the last 10 or 20 years, but what about the future? How will we invest, manage our money, and plan our financial lives 10 years from now? Our guest on this episode is Jason Butler. Jason is a former financial planner. He's an author and educator, and he's a financial entrepreneur and angel investor. Jason will be telling us why over the next decade, the UK will be at the forefront of positive change in investing and advice.
Data, technology, and a very strong regulatory regime. We've got the perfect solutions, the perfect environment in the UK for us to have great outcomes for consumers.
He'll explain how artificial intelligence is improving all the time and will completely revolutionize this industry.
AI is now here to become your personal assistant about your money. The difference and the challenge and the opportunity is consumers within the next 5 years will want to know that the AI they're engaging with is using genuine information, is not going off-piste, and it can the person who's interacting can trust what it's saying.
And we'll also be asking, will there still be a place for human advisors and face-to-face interaction with clients?
I liken it to doctors, GPs, consultants. There aren't enough to go round for the people who need them. And what we should be using is humans, very, very experienced humans, for the most complicated, difficult situations which require really ultra high levels of empathy and that are almost at this stage too difficult to put into an algorithm and or for the AI agent to be interpreting or asking you questions.
So on to the interview. I started by asking Jason how he became a financial disruptor.
Well, yeah, I fell into it like most things in my life. In financial services, I was a financial advisor for about 25 years. And I sort of retired, I did retire from financial advice when I was 46. And I always felt like there was a bigger play, as it were. Just dealing with a small number of clients, helping rich people get richer wasn't exciting to me. Although I liked the clients and I loved their stories and I loved the positive force that money could be for them, it could also be a negative. And I suppose I fell into it because obviously I had capital. I am entrepreneurial, and I like to think beyond the given confines. I like to think, how can we add more value? And so I suppose I fell into my first angel investing. In fact, as a business, I did actually make a return on, but it didn't change the world. Initially, so I thought to myself, I like this. I like business people. I like people trying to solve problems. But I've got to get better at this. I've got to get better. I have some sort of screening process, some kind of validation. And so I fell into, because I understand financial services, I understand the issues that people faced and face, and I understood how clunky technology was, but I knew that technology and different ways of working and different ways of connecting with clients and customers, it was a bit like all the ingredients were there to help people have better outcomes. So as someone who had number phobia at school and who overcome that, and who also was very, very, impulsive with money in my early 20s, I kind of understand what it's like if you're frightened of numbers, if you are impulsive and perhaps haven't got self-discipline, and adding complexity, and then perhaps a little bit of earning a bit of money or an odd windfall, it then becomes complicated. And so I always think of things from the average person's point of view. So fast forward, in the last 10 years, my current holdings, I've got 15 holdings. I've had exits from businesses that have pioneered different things, and I'm still involved in a number of businesses. And including, obviously, Timeline was one that I backed originally in its early days, because it was trying to do something different. It was re-engineering how clients and customers and their advisors interacted with their money and their planning and their investments so that they can have better outcomes. So, yeah, I fell into it, but I love backing companies. It's not for the faint-hearted, and I back companies with both my knowledge, my capital, or my children's inheritance, but also the fact that I back people, and I'm backing the pioneers who are trying to deliver better outcomes for the everyday person who's out there.
Now, UK financial services, particularly the sort of larger financial institutions, it's a very conservative with a small c sector. And yet, considering that, we seem to have experienced actually quite a lot of disruption over the last couple of decades. Would you say that's true?
I would. I mean, there is innovation in the United States and in Europe, but and again, there are lots of problems with the UK as a country, but one of the things we do have is an entrepreneurial spirit. You wouldn't think it when you hear what the politicians say, but there is a very strong entrepreneurial reservoir of talent in this country. And also it's quite easy to raise capital in the UK because of the tax benefits. There are substantial tax benefits for people raising early stage capital. It's not easy, but it's possible. But also, and in fairness, there's not I wouldn't always say the regulator's been what I call 100%, but in innovation and trying to foster new ways of thinking, the regulator have been quite supportive over the years, particularly with things called the sandbox, which is where you can go to them with an idea and say, actually, can we try something a bit different? And that's only possible because we have very, very strong regulation. So the UK regulatory environment is the toughest, the most thorough, the most comprehensive, the most consumer grounded in the world. And I know because I've been all around the world and I've interacted with lots of business people. American standards of suitability and appropriateness and outcomes for consumers is nothing compared to the UK. And in Europe, it's even lower because it's very much driven by big organisations like the banks and insurance companies. In the UK, we've always had a very strong independent financial advisor sector. Now, there are different flavours of independent advisor. Some are like a small restriction number of solutions they can give. But what we've got is that lovely combination of access to startup capital, entrepreneurial drive and talent, a supportive regulator and a strong regime that enables us to, we've dealt with all those issues of before about people without qualifications didn't understand. And then you add in the innovations in technology, what's possible now. I mean, if you sat down now and thought about how you would build a house, you wouldn't build a house the same way you would build it 100 years ago. And so therefore you wouldn't start a financial services organisation, whether that be a bank, a financial advisor, an investment manager, exactly as you probably were running it 5 years ago, with all of the solutions and tools that are available now. You can start afresh. You can actually start in a different way. So a bit like years ago, when you were building a house, you always did, a concrete screed. Now you could do a concrete screed and probably add more insulation to it, but you can also do block and beam, which is actually probably the more modern way of doing it. So again, it's the same with your finances. There are things now, and we'll come on to it, I'm sure, but for instance, open banking, which is this thing that really was pioneered in the UK, really, of access to your data is actually not just someone else's currency and something they can use to make money out of you. It's something that can give you insights. Something that can help save you time, and it's something that can help save you money and make better decisions. And so if you think about data, technology, and a very strong regulatory regime, we've got the perfect solutions, the perfect environment in the UK for us to have great outcomes for consumers.
Perhaps the most obvious example of disruption in financial services globally over the last 20 years or so has been this move away from active fund management, active investing generally, towards more passive or at least systematic styles of investing. How much further do you think that has to run, that particular trend?
Well, you've got to remember, in any market, there's always a reason for people to buy and sell. So whether that's the same, whether it's a stock market, whether that's a minerals market, commodities, or investments. So the point is there's always a market. There will always be a need for people to buy and sell regardless. And so the point at which, if everyone is buying a fund that tracks the index, that's sort of the tail wagging the dog, I don't know when that point is. Everything I've seen says that we've still got plenty to go. And even if the index market was the majority, 60, 70%, there will always be people transacting along the edges, even if there wasn't a big active management industry, because they have to buy and they have to sell and they have to sort of make changes. It's a bit like housing. At the moment, I'm sitting on a lot of cash and no house because I've sold my house, and I'm waiting for another 3 Ds, death, divorce, or debt, because that's why people have to sell as opposed to want to sell. So again, it's the same with the market. So in answer to your question, I think there's still a long way to go. But here's the other thing. What the move to index investing has done is put a big spotlight on don't pay for what you don't get. Now, one of the reasons why active funds have tended to not outperform the market, or certainly not the same funds outperforming the market consistently, if they do outperform, it's often either luck as opposed to skill, or it's just they were in the right risk factor, perhaps smaller companies, value companies, whatever. What you're seeing now is in the active market, the cost of those funds is starting to come down. So that's the same at the institutional level with big companies, big investment mandates, and the individual retail investor. So you as a retail investor can probably pay less for active management than you did in the past. Now, the point here is one of the reasons why active funds often have such a bigger hurdle to get over is because its costs are higher. Now, we know, and I know we've talked over the years about this, costs are certain, investment returns aren't. So if you don't know what the investment returns are going to be and it's a coin flip, you might as well go for the investment index fund, which is low cost, and you're going to get the return of the market. And for most people, that is perfect. But what you are going to start to see, I think, over the next 10 years is as prices come down on active funds, there will be more active managers who persist. Their performance is actually skill, and they are exploiting market economies. And that will continue. So in other words, as costs come down, and as more indexation goes up, which is not perfect indexation, index funds go up more and more, there will be more opportunities, not massive, and it doesn't need to change people's investment approach, but I'm saying there will be more opportunities for active managers to exploit that. Now, how persistent they will be and whether it's even worth most people worrying about that, what I think will happen is once most people have got the bulk of their money in index funds, there may be a case that there may be some active investment managers, because their fees are lower and they can demonstrate consistent skill, that you might want to think about that in the future. I'm not saying that's now, but what I am saying is it's a potential in the future. So I think we've got plenty to go with the index market, and I certainly have the bulk of my money in index funds, and I'm very happy with that. The market return is great. It's great for me, great for my daughters, great for my wife. Active management, I think you've got to keep a watching eye on it because it might come back into flavour as the market becomes predominantly index and the cost of active management comes right down.
You're right, we're certainly seeing an increase, particularly in the number of actively managed ETFs, which generally are cheaper than traditional active mutual funds. But these actively managed ETFs, option-based ETFs and so on, they're still more expensive than the index alternative, if you like. Are they really an improvement on what we already have?
There's two ways to answer that question. You've got to remember, exchange-traded funds, which is what you're talking about, it's like a share of an investment fund that's traded daily. That was never designed for people to have what I call great long-term outcomes. It was designed as a speculation tool. And it's designed as a means for investment exchanges to make money. That's what it is. And the fund groups who provide them to have a higher margin than if they just provided an index fund. So all the time there's someone who wants to believe the possibility of outperformance, and all the time there are people who want to speculate, even if they don't want to buy and hold, then ETFs fill that need. The question is do you as a person who's investing their family money for good outcomes, do you need to get involved in that? And my answer for most people is probably not. So don't confuse, a bit like betting and gambling, as I always say, I think I've got some Bitcoin somewhere, but I don't convince myself that that's a long-term investment strategy. I think I bought it for educational purposes, and how to get into the fund, I don't know even how to get into it. It was of interest, but I'm not betting the family ranch on it. So you've got to remember, the fact that a product is there doesn't mean it necessarily makes sense for you. And get your house in order in terms of the bulk of your money in index funds where they're low cost, you're going to get the market return in the right combination, in the right wrappers, for the right reason, with the right time horizon. Do that first, and that will be 80% of your outcome, and then perhaps look at these other things, whether it be active management, whether it be active ETFs, however you want to look at it. But I think for most people, that's going to be the sort of the last thing they need to worry about.
I'd like to move on to so-called Robo advisors now. Say 10, 15 years ago, it was taking a long time for these firms to become profitable, if you like. But in recent years, we've seen the likes of Wealthify, Money Farm, Nutmeg, all starting to turn a profit. It looks as though they are finally here to stay now.
Well, look, if you spend £100 million, all right, and you wait long enough in a market that's growing, you're probably going to eventually make a profit. Is that a good use of capital? I don't know. And also, we've got to remember, what is it most of these companies are providing? They're providing a really simple way of you buying investments. So on that basis, if more people invest their capital as opposed to leave it in cash, if more people take a longer term view and squirrel away some of their money rather than spending it all, then that's great. But we mustn't confuse this idea of robo-advisor. They're not advisors, and they're not even robo, really. What they are is a digital investment selling solution. And so if it makes more people invest for the right reasons and build up investable assets and take a longer term view, it's great. Whether they were a great investment, I'm doubtful. There's been millions and millions spent on these businesses. They are just making a profit now, but you'd expect them to. But if you take into account how long it's going to take them to pay back the original capital, I think most of them will not be like most pioneers. The people who are first are not necessarily the ones that make the money. What I'm excited now about, and which we'll come on to, I'm sure, is not just the ability for people to interact with their money very simply in a digital format and buy low-cost investment solutions. I'm much more excited about them interacting with their money to make better decisions than hitherto has been available.
And you think that is coming?
Well, I don't think it's coming. I know it's coming because I'm investing in some of the businesses that produce this technology.
So just give me examples of how in future we might be able to interact better with our money.
All right, so remember, investing in an ETF or an index fund or a pension or an ISA wrapper or whatever, that's not the issue. It's a bit like saying there's a really easy way of buying bricks and sand and timber. Okay. But why do I need bricks, sand and timber? If what I really need to do is clear my garden out of all the rubbish and all the old tyres and hack back all the weeds, I don't need any instruments. What I need to do is get my house in order. And it's the same with most people's finances. What most people need to do is understand where the money that they're earning or have coming in is going. And then optimise that spending, stuff you have to spend, don't spend more than you need to, perhaps change suppliers, and then create margin in your budget for things that are going to help you become more financially secure, that are going to help you make work optional, that are going to give you some flexibility if things change or income drops or you get ill. And so what we're really seeing now is the evolution of not just the ability to buy investment solutions, but what we're really seeing now is the combination of open banking, which is where all my money's going, budgeting insights like spending plans and controlling where it's going and understanding where it's going and plugging leaks in your spending, making margin, getting insights as to how can I clear the garden before I order any materials. So it's getting your financial house in order, getting the basics right, which don't involve you buying products. And that does involve you can create rules that people, so for instance, if you gave me an A3 piece of paper and I volunteer and help at my local Citizens Advice and I meet lots of vulnerable people, but I follow a framework which I've developed over many years for helping them make sensible decisions. Doesn't matter what the problem is. Now we're talking here about people's finances, but any problem you can codify it. You can actually say, you start here, okay, what are your issues? And then you can basically create what we call a digital pathway to help people make decisions. That's called an algorithm. Now, an algorithm is not that complicated. It takes time, but it's just yes, no, this way, that way, this way, that way. And there gets a point where the vast majority of the vast majority can be dealt with through this algorithm, which can say, tell us about you, okay, turn left, turn right, when you get here, turn left, based on what you tell us, okay? That's called advice. But in order to get people to go through that process, what we have to do is get them to engage with their money. So yes, it's great to have open banking. I know where my money's going and have insights. It's great to have a digital pathway that can help me make the decisions. Okay, it's a bit like, you've got to this point. Okay, tell us more. Okay, we think you should go down this path. But then it's actually, you've got questions. well, hang on a minute. What's the pros and cons about me paying off my mortgage versus investing? You know, I'm going out with this person. I'm not married to them. Should I combine my finances? There's lots of questions we want to ask, okay, that are personal to us. And this is a real key point. And this is where the dreaded AI word comes in. So AI, think of AI as a rapid, fast way of technology accessing rules, information, and insights and what works to give you an answer that's tailored to your question. Okay? So that question of what's the pros and cons of paying off my mortgage versus investing? So the AI can go into its data bank, bring out an answer and says, look, it's a good question you've asked that because actually this does change over time based on your circumstances. So in other words, how I would give an answer. But AI, what it enables us to do is create a highly personalized answer to you based on a question you're asking while you're interacting digitally with your money. Okay? Now, hitherto, chatbots, which you engage with online, there are companies that have chatbots where you play around with them on the left-hand side and they ask you, you know, what can we do to help you? And basically, you know it's AI, it's useless. They might as well just put you straight through to a human in the first place because all it's done is giving you a bad experience. So what the next generation of AI agents are doing, or will be able to do in financial services, is they won't just interact with you. They will interact with you and give you answers that are not necessarily financial advice. They're insights and answers to your questions, okay? But the advice will be delivered through the algorithm, which is the rules. But the AI agent will interact with you to be like your friend, asking for a friend. You know, it's just all those questions you were embarrassed to ask. But the difference, you know, most people are interacting at some level with AI. So whether they're using ChatGPT every day or Anthropic, or whether they're interacting with a chatbot on a website somewhere, whether they're aware of it or they're not, whether it's a conscious decision or an unconscious decision. But where the opportunity lies and the benefits for consumers is when the AI agent has been trained purely on financial services, has been trained to not go off-piste and take useless information that is not relevant, that goes beyond hyper-personalized answers and starts to stray into advice. So in other words, what I'm saying is AI is now here to become your personal assistant about your money. The difference and the challenge and the opportunity is consumers within the next 5 years will want to know that the AI they're engaging with is using genuine information, is not going off-piste, and it can the person who's interacting can trust what it's saying. So I know one of the companies I'm involved in, the training of the AI, okay, to not go beyond, in other words, to not go beyond what is true information, but also teaching it how to be empathetic. So if I said, look, I'm coming into a £10,000 inheritance and I'm a bit nervous about knowing what to do with it. What do you think I should be thinking of? Well, you don't just want a chat, you know, the AI agent to come back and say, what, you've got lots of options. That's great. Well done. Do you know, it's an exciting time, but I can appreciate it's probably a scary time. And it's great that you're asking. Let's take you through a few things. So again, the AI is not just where it's getting its information and how it's interacting, it's that empathy level.
Do you see this kind of AI technology challenging traditional human financial advisors, or do you think traditional advisors will actually be harnessing this technology themselves increasingly?
Well, a lot of my friends, for you know, whether it's good or bad, are financial advisors, and they are so busy, it's unbelievable. I liken it to doctors, okay, GPs, consultants. There aren't enough to go round for the people who need them. And what we should be using is humans, very, very experienced humans, for the most complicated, difficult situations which require really ultra high levels of empathy and that are almost at this stage too difficult to put into an algorithm and or for the AI agent to be interpreting or asking you questions. And so I see the new AI financial agent, which you can trust, which has been trained properly on financial services, financial advice, financial rules, your country's rules, etc. I see that as actually addressing the problem that 91% of the population, certainly in the UK, and I know this is similar in the United States and Europe, etc., and Asia, it's actually going to be addressing the vast majority of people who can't get access to any kind of personalised guidance, help, advice, insights, or signposting. And so therefore there's a massive market of people who are unserved. But there's no doubt that there are some people who are engaging with human-driven, what I call old-school advice, even if they're using computers and latest tech. That's really a bit like, it all looks lovely, but actually there's a load of people behind the scenes, a bit like the Emperor's New, what's it called, the Wizard of Oz, behind the curtain. There's still people, even though it's all shiny and lovely, there's still loads of people doing lots of stuff.
Yeah.
So there'll always be a place for humans, but what I think you'll find now is that the entry point for most people will be open banking, AI agent, and some kind of algorithm to help them do the basics, the cleaning the garden out before you worry about ordering anything, almost acting as a triage. And where people can stay in that digital world, I think they should stay in that digital world because the cost will be a lot lower. Don't need a high level of sophistication. But where there are opportunities, either because there's a one-off event like a big inheritance, or there's a big career change, or they need a level of interaction where they're prepared to pay more because the value they're being delivered. Say, for instance, my daughter at the moment, she's a software engineer, and she said, "Dad, how do you negotiate pay rises? Without looking greedy, but making sure you're getting paid for what you do." So that's a great question for an AI agent that's trained on all this, that can draw on insights. But there might be a stage where if the stakes are big enough, you actually want to speak to a human to actually coach you in a way beyond AI that's personal to you because the stakes are higher. But for most people, the AI will be able to help you have a respectful conversation, get prepared for it, make sure, it might be you're not ready for the pay rise. You need to actually get some more skills and more experience and choose your time right. That's great, isn't it? That's good for the employer, good for the employee, good for the individual. But where it's high stakes and it's a bit more complicated than the normal, you might actually want that personal touch. Now, that human is probably almost going to be delivered most of the time via FaceTime or, video link or whatever. And it could even be interaction digitally, etc. But the point is we need to reserve the humans for the most complicated, the most high stakes, the bit where you need that reassurance, or you actually want to physically connect with someone. That doesn't mean to say you need to be seeing someone every year or every 6 months and have a cup of tea with them. You need to see them when you need to see them. So I think there will be a lot of people who don't need human interaction. Even those that do need human interaction won't be needing it yearly. It will be when they need it. But everyone will be interacting with their finances from a digital floor plan. And whoever provides the AI agent that interacts with them, I think will do very well. And I'd like to think that, my children will be very pleased that I've got involved in companies. But let me tell you, it's not easy. We are dealing with money is emotive. It very much reflects people's identity. We get it all the time. We've got these things, tax the rich, we've got the people who are poor, we've got the benefits. It's very emotive because money is that currency, isn't it? But I do think I'm very optimistic that the democratization of good decisions and good outcomes is much more likely to be more pervasive and be available to more people at a price that they can afford and are willing to pay, because we've made it actually more accessible. And that's what keeps me excited. You said, what do I do now? What I do is I find crazy mad people who are trying to rip up the rule book, use new technology to create a different experience. And I think we'll be sitting here in 10 years' time saying, who on earth takes financial advice without first of all consulting the AI in their pocket? But they want AI they can trust.
You mentioned affordability there, and we've certainly seen in recent years disruption in charging models for financial advice and a move away from percentage-based charging, although that's still the norm here in the UK, and towards, for example, fixed fees, subscription fee models. I know you've been involved in that area as well. How do you think people will pay for advice in the future?
I don't think you can say there'll be one route or the other. I think the percentage-based model will still have a lot of legs for a long period of time. The question is how much that will be and to what extent that will be the only way that people pay, I don't know. What I do know is that the price of everything will be driven down. There's no question about that. and the value being delivered will be driven up. So if price goes down and outcomes improve and your experience of the whole thing, and you don't feel embarrassed about money, you feel like you're making smart choices. If your experience and your outcomes get better and the price goes down, that just is brilliant for consumers. So I think what will happen is employers will get behind sponsoring, not just benefits, they will get behind sponsoring, whether it's this AI agent, whether this be some sort of guidance service, and it will be digital first. I think employers will get behind that, and that will be a differentiator. I know from one of my businesses that provides money first aid courses, Money First Aider, they are training people in the workplace to be kind of the first beacons of excellence or the beacons of consciousness to spot people, a bit like mental health first aiding was 15 years ago. This is money first aiding. This is being aware of when people might be having money issues and signposting them. That will become also digital. So I think what you'll find is I think people will pay a subscription if they get value. If the subscription is a fraction of the money they either save or the returns that they get, I think people will be prepared to pay. But it will start, I think, in the workplace. It will also be sponsored, I think. Maybe even be the government gets behind some of this. And I think also you will have products providers sponsoring this. So, for instance, most, you call them Robo advisors, I would say, well, they may actually be prepared to sponsor this, sponsor you having free access to the basic planning portal, and not talking about investing first, talk about planning first. What's important to me in my life? What's the role of money in it? Where am I now? What are my gaps? What are the things I need to be focusing on? If what you need to be focusing on is cutting out subscriptions and stop using contact lists and be more conscious about your fund money and have conversations with your partner about what's important, keeping you awake at night, if that's the most important thing, and it's all about behavior and habits, it's not necessarily these big calls about which funds to invest in, but if those fund groups and those financial services, I call it materials providers, if they were to sponsor or subsidise the free use of these tools on the basis that gets them a table stake that you might then start to eventually buy their products, I think you'll see a lot of that. So I think from a consumer's point of view, if it were me and I talk to my friends and I say, look, if you want advice and you want a human, whether it's digital first with, and the possibility of a human, I'd always be paying a fixed fee. I'd always want to pay a subscription. You're seeing these businesses now in America, subscription-based services. You're starting to see now subscription-based services in the UK of money coaches. And so these aren't financial advisors. These are people who there is some sort of digital app you're using, and then you can speak to their money coaches. That I don't think is going to be the predominant model. I think what you'll do is you'll interact with your AI, and you'll only then interact with a human money coach virtually if you're prepared to pay a premium or if it makes sense. The companies that are doing this digital app, and the money coaches all within it, that's not scalable because there aren't enough people, even money coaches, because they're not qualified as much as a financial advisor, but they're still useful people. Their view is, well, we need the humans to get people over the mile. No, I don't think so. If you have a better digital solution that just works, a bit like Apple, it just works, and I build confidence, and I can ask it anything in the comfort of my own bedroom. I think that's when you then sort of think, actually, I would like to actually speak to a human. I would like my own personal coach. I am prepared to pay 25 quid a month for a year for that, because I've now got myself, so I'm not embarrassed. I know the bottom line's right. I've got all my information right. The money coach can then do an intervention with me that helps reinforce my confidence, my capability, and my desire to want to do good things. So I think there's going to be a multitude of charging models, but it's got to start from make it super simple and easy for people to interact with their money in a meaningful way that's not all about the cheapest insurance, but it's actually much more fundamental about your relationship with money and the way that you develop your habits and behaviours around it.
I'd like to ask you now about alternative investments. I mean, of course, these were once the preserve of institutions, but increasingly now retail ordinary investors have access to private equity, venture capital and private credit and so on through platforms like Moonfair. Of course, these products are also quite complex sometimes. They're often illiquid and usually quite expensive. Do you see more investors moving into alternatives in the future?
Well, I was reading a report recently that showed that some of the big endowments, these big enormous endowments like Yale and what have you, Harvard, they've underperformed. They have quite a big allocation to these alternatives, and they've underperformed just the normal, a diversified bond and equity portfolio. So the cost of this, and this is over long periods of time, 10, 15, 20 years. And so if those super smart people with all the real smart people there have invested in alternatives and they're underperforming a boring diversified bond equity portfolio, you have to ask yourself, if they can't get it right, why would you, as just a little Joe or Joanna, get it right? So my feeling on this is most of this stuff is solutions looking for a problem, okay? You've got to remember, it's a bit like fine art, all these things. I'm not saying don't invest in things that are different or sound interesting. What I'm saying is get your basic house in order first. It's a bit like me. I invest in private equity, but my own private equity. And there's an interesting story. When I first started investing in private equity, or rather halfway through my journey, I was encouraged, or I would use the word convinced, but I wouldn't say that. I did it of my own fruition to join a syndicate. And I invested for a syndicate, but I put a modest amount in that syndicate. So a modest amount for me, that was £75,000, okay? I know it's a lot of money, but it was modest for me in what I'm doing. And because I was not sure I wanted to delegate the choosing of people. So when I choose investments, I'm choosing the founders first. Are they good people? Are they sort of people who would be awake all night trying to solve a problem? Will they give up the first sign of trouble? And do they really care about committed to the cause? And then secondly, the problem. What's the problem they're trying to solve? And do I have some sort of confidence they're going in the right direction? My stuff that I've chosen, where I've carefully selected the individuals, has gone the right way. And, overall I've done very well. But the stuff in the syndicate, all I get is phone calls about it's gone down, it's gone. I don't even know. I've written it off now, the whole lot. They say that there's something in there worth of every other month, one of the companies has run out of money, gone bang. I mean, even when they did the investments, I looked at it and I thought, well, I don't understand this company they're investing in. Well, I don't know anything about games producers. I don't know anything about logistics. So I would say if you're going to invest in alternatives, invest in it either because it gives you fun and pleasure, like my friend is an investor in Chapel Down Wine, which is great because we go to the shareholder days and we enjoy it, but he's not made much money on his shares, or fine art or something, or because you know something about it. So if you're going to invest in technology, it's because you worked in that sector, or it's a social purpose company where it's doing something good and it's not about the investing, it's about trying to make a difference in the world, and the investing is a secondary thing. But most people need to get their basic house in order.
So before we finish, maybe we could look at what the financial services sector will look like, say, in 10 or 20 years from now. What are your main predictions?
I think we are going to have a basic ecosystem, a floor plan, if you will, where open banking apps, budgeting apps, price comparison, they will all morph into one kind of floor plan, if you will. And they will be augmented with automated advice, proper advice, that is interacting with you through a properly trained and carefully policed AI agent who understands personal finance, who can make sense of things for you, who can feed the advice engine. And that will be the floor plan for everyone, even super high net worths. People with multiple millions. That will be the floor plan, I believe. A bit like everyone has a national insurance number and they have the basic state pension, right? But it will be augmented by, as I say, avatars. Okay, so they're replicable things that are like humans, but they're actually AI created off of someone. They'll be augmented by, further up, real humans are interacting with you, a money coach, possibly a customer service representative who's working out whether you need to see an advisor, perhaps financial advisors, or in the really complicated stuff, a physical, real human advisor who needs to actually talk to you. But even then, I don't think they need to be in the same room. And I think the same thing will happen in conveyancing, in law, and what I think you might find is a merging of certain delivery of tax preparation, your tax returns, because tax is getting more complicated, more people being drawn into it, of legal things, whether it's buying and selling your house, your wills. And this idea of a financial advisor, I think, will be actually more like the point person to your plan. So the financial planner built a digital floor plan, augmented with money coaches or financial planners who can bring in the accountant and the solicitor functions. You might find that actually that becomes one single thing. And human advisors, whether it be law, accountancy, tax, or investment, they will be for the most complicated, most difficult, most sort of moving parts, as it were, and you will pay a premium for those.
So all of these things are coming, but what we have now is still quite different to that. I know you yourself use a proper real-life financial planner. Presumably you would say that that is still the gold standard, having a real-life planner on an ongoing basis if you can afford it.
Well, no, my financial planner is the fallback. My financial planner is not doing all the day-to-day. My financial planner is if I'm not around and my wife and my daughter can't or don't want to engage with the money, him and his firm are there as fallback. They're the fallback guys. But here's the interesting thing is I have all of my affairs in a digital vault, okay, a new style digital vault, which is basically the floor plan for which is a key that my daughter and my wife can turn so that my financial planning fallback team can then immediately see what everything's there. They broadly know what's there, but I'm dealing with it while I'm here, because why would I pay someone? But they're there as my support team. And this is another thing, getting financially organised is the key thing. And I've just had to recently go through this thing. My eldest daughter's 26 and she's got the big guide to what to do if dad goes, gets disabled, incapacitated or dies. And she said, Dad, yeah, it's really great. It's very, very comprehensive. You haven't forgotten anything. And I know exactly where everything is and I feel very confident. She said, but don't get ill, don't get disabled and don't die.
Love it. Well, let's hope you don't soon, Jason, because that's been really helpful, and you've, down the years, offered so much very sensible advice to investors and clients. Thank you very much for your time.
Pleasure.
That was my interview with Jason Butler. We're very grateful to Jason and also to our sponsor, Timeline. Timeline provides best-in-class planning technology and portfolio management solutions that enable advice firms to deliver exceptional value to their clients. If you enjoyed this interview with Jason Butler, why not subscribe to The Evidence-Based Investor? And please leave us a comment. We're always grateful for your feedback. That's all from this episode. Until next time, goodbye.